Hi friends, and welcome to the 100th episode of Arctic Money. I have reached the 100 milestone now, and I have a treat for you, and the treat is my risk-reward matrix, which obviously aims to answer the question, what stocks would I buy now, today, if I had the need? And of course, I always do try to keep a little bit cash available always to make good buys here. But idea of my risk reward matrix, for those of you who haven't watched these videos before, is to put all the companies in my watch list to this risk reward perspective, where reward obviously is the gain I expect from the stock. So yeah, pretty self-evident what that means. But the risk axis here actually means the risk related to business itself, how much risks do I see around it. But it also has the factor of how well do I understand the company and how well do I understand the business. So it basically there is two factors in risk, so to speak here. I kind of like this matrix. Obviously, everybody needs to do one for themselves. This is only my matrix, which, as I said, reflects on what I see the risks around the companies, how well I understand them, and what is my valuation, what I expect as a reward. Here on front of you, you can see my risk-reward matrix from last November to November 2024, and soon we will go to the updated one. But let me first highlight from some developments from this November risk-reward matrix. For example, I had a little bit hits here happening during the last 4 months or so. Alibaba has obviously gone up pretty well in the price, something like 50% up. Burberry was, I guess, more than 50% during this time, or a little bit earlier. Burberry was one of my big positions and it went up hugely, so I did great profit with Burberry. Also, flow traders, a component that has existed long in my portfolio, has gone up pretty much since November. So I would like to highlight these three companies. Alibaba, Flow Traders, and Burberry seem like hits from my November risk-reward matrix. So congratulations to those people who owned them, I guess, including me. Rest of them, not so much yet. We are waiting for results. But as you know, investing is a game for patient people. And I have said that I expect my profits to materialize in, well, it's great if they materialize tomorrow, obviously, but along with Peter Lynch and other famous investors, I have a 2 to 8 year, 2 to 10 year horizon in my investments. So I would say that if after 8 years or 10 years, the investment hasn't had the returns I expected it to have, well, then it's a failure due to time and opportunity cost, obviously. But in investing, you need to have that patience to sometimes wait for a long time before you see that value unlocking in your stocks. Excuse me. So, what else? Let me highlight that the big tech, obviously you have seen me maybe for a little bit too long saying that it's too expensive, but this time around I was correct. We have seen corrections, for example, not so much actually in Meta, but since November, Apple is down, Microsoft is down, Alphabet is down. Of course, I put Alphabet to a little bit better risk-reward profile there, as you can see, but nevertheless, it's on the left side of the reward axis, meaning that I wouldn't own it, basically. They have gone down also due to probably some political developments in the United States. We have seen underwhelming performance by General Dynamics and Lockheed Martin too. Let's talk about that a little bit later. Also Tesla, which is hugely expensive stock and has been that for the last 5 years, as I have told you many times. Also Tesla stock price has pretty much crashed since November, so I got that call right too. So this was the situation in November. Luxury and fashion seems cheap, and even though we didn't have such major increases in stock price of LVMH and Kering, for example, that were small positions, my biggest position in fashion and big position in my portfolio was Burberry, so that was a hit for me, definitely a hit there. US Tech and S&P 500 seemed expensive to me in November, and look where we are. They were expensive and they have declined in stock price. And yeah, that's about it. And now we continue to this day, which you see right in front of you now. So here it is, 16th of March, that we are living today when I'm filming this. My new risk reward matrix. Before getting more into the companies, let me say a few things. I stopped following some companies due to many reasons, which I'm not going to get into this video, or this video will be too long. So as you can see from the last risk reward matrix, some stocks I have stopped following actively, let's say so. So I deleted them from this risk reward matrix in order to make some space to some new interesting ones which you haven't seen before, which are in this risk reward matrix now. Just looking at the overall picture of the companies from my watch list in this risk reward, for the first time I feel that my risk reward matrix is really scattered. There is companies all around the risk reward matrix, so to speak. I believe the market is truly offering some great deals at the moment, but also some really bad ones. This is now, after a decade or so, this market has been index investors' market, but I really feel that now we have entered to the stock pickers' world, which I try to be here myself too. I truly believe so, that the time for index overperformance is over, and to be honest, I'm quite excited about it, and I have been looking forward to this even. I think small caps here offer huge rewards, but of course with greater risk than maybe more established companies. Also, let me say that Google and Berkshire Hathaway begin to look pretty good out of the big companies to me, honestly. Then, before we get into the company level, some major changes in my thinking since the last risk reward matrix, which I just want to point out directly to everyone here. Elon Musk risk with Tesla has begun really to materialize, something I have always warned you about Elon Musk, his out of Tesla extra activities that everybody is aware of. I have said you 1 year ago or 2 years ago already that I feel that Elon Musk is more of a liability than asset for Tesla nowadays. Obviously, in the history it was different, but we live today, and I think people who still defend Elon Musk and his actions are pretty much in denial of how bad thing he is for Tesla and Tesla shareholders. And I really think this way. I warned you about this. I warned you about this many times, to be honest. And I think people who just say that this is not a risk and so forth, I think those people are a little bit in denial of what is happening, what you're seeing in front of you. But yeah, other things, as I briefly already mentioned, Lockheed Martin and General Dynamics, I have a little bit, these two US defense contractors, defense companies, I have a little bit increased their risk profile due to what Donald Trump, the President of the United States, is doing for the companies. He's really hurting them. With customers here in Europe, where I'm from, United States is not viewed as a trustworthy ally anymore. That's the reality, and this reality looks really bad for United States defense companies, in my opinion, for the future. For example, Europe, that is heavily rearming itself, you will see that after a few years, maybe even sooner, European countries start prioritizing products from defense companies. Number one, especially from Europe itself, inside Europe, but also countries such as South Korea, who are viewed as more reliable partners to us than United States is at the moment. Also, I'm probably gonna get some hate from some people watching this video again, who may I'm not pushing my political views or politics here. I'm just telling you how I see it is, and I am pretty sure that in the boardrooms of Lockheed Martin and General Dynamics, the executives are not happy at the moment of what they are seeing. This is what I predict is going on there. And again, as with Tesla and Elon Musk, I think you are kind of in denial if you don't want to see this. Then another thing I want to mention still, carriage services, funeral home operator. I have put that up quite a lot in the risk profile too, and reason for this is that I think carriage services might be in a bit of a trouble with their debt in the future. So that is the reason, if somebody is really looking closely at these risk rewards, why you see carriage services going up in the risk profile. I think the valuation is too high at the moment, and also think that the risk of the company is too high at the moment. I made in the past, last year, or was it already 2 years ago, good money with carriage services. Things seemed a little bit different back then, but now I see the company more riskier than before. So these I just wanted to say. Now let's go through quickly what we see here in the risk reward matrix. So obviously, let's start with the right upper corner where we have Kamux, Finnish company that sells used cars in Finland, Sweden, and Germany. I think the valuation is very attractive. Bad thing is that Kamux doesn't have a moat. It's a company without moat, in my opinion, which obviously makes it a high-risk investment. Used car sales, that's just an industry where I haven't identified true moats at all. So this is why it's higher up in the risk profile, but I have invested heavily in Kamux because I think the valuation is super cheap. Dr. Martens, boots manufacturer from UK, didn't follow Burberry up in stock price when Burberry went to the moon, so to speak. Dr. Martens is still cheap. Strong brand, in my opinion, has existed for ages. Is surprisingly low, trading with surprisingly low stock price, in my opinion. I think the valuation is great. Let's see if this is just temporary headwinds pushing the stock down and I will make good money with it. It seems like I need to be more patient with it, but it's definitely a big part of my portfolio. The valuation is attractive. Then if we move a little bit downwards, we see Origin Enterprises, agriculture related, doing many stuff in that agriculture and related industries. Origin Enterprises from Ireland. I feel that this actually is pretty well positioned, this company, in a boring industry with surely some competition, but not the most highly competitive environment. So the risk profile is lower than with Kamux or Dr. Martens, but the valuation is also super attractive at the moment, I think. Then we have there in between uranium. Well, I have lots of videos in my channel on uranium. You are interested more about this investment case, go and watch those. Then we have two newcomers there, a little bit down from uranium. You can see ESOA, which means Energy Services of America Corporation, a small cap energy corporation from the United States, doing pipeline works, electrical works, water works, repairing of all energy related, doing many things, and I feel like this company could grow their business, expand inside the United States, and could be a real compounder for the future. Obviously a small cap, so there is obviously lots of risk, but I think this small company can grow big in the future, and that's where the reward lies. BML, Biomedical Laboratories from Japan, testing company from Japan. Not much has happened with the stock. Absolutely necessary company in Japan, doing what they do in healthcare sector there with aging population in Japan. Attractively valued. Don't really know what is the catalyst for the stock price to go up, but I feel the valuation is attractive, and this Japanese company represents Japan in my portfolio, and I think, as I said, attractive valuation, nothing too fancy about it. Absolute critical industry, critical company for the health of Japanese people, and cheap valuation, so why not? Then we have Crocs, small position actually in my portfolio, yeah, I think Crocs is okay valued and presents a good opportunity. The company is pretty amazing what they have done through the years. Seems like obvious, like to some people probably that Crocs would be a meme stock or something, but looking at their financials, the company just keeps on delivering. I can't say much more. Then Flow Traders, liquidity provider from the Netherlands, has seen good movement with the stock price upwards. So those who invested when the Flow Traders was hitting bottom a few months ago have already done great. This is a company that stock price is quite correlated to VIX index, so volatility, but also has been expanding a little bit outside of that, so that if VIX goes crazy and the market gets really volatile, Flow Traders will obviously do good, but they have a little bit diversified apparently their business nowadays, so not so much VIX correlated anymore, I can see. So I think could be an extremely great investment should the volatility in the stock market for some reason pick up, and obviously it can pick up. I'm sensing it maybe should pick up, and we should be in for a bigger correction. These types of environment where things are going a little bit crazy all over the place in cryptos, in Bitcoin, in stock markets, this would be the kind of environment Flow Traders would flourish in. So big part of my portfolio still. Then one newcomer there, Hims and Hers, telehealth operator in the United States, I think also in the UK actually, but mainly in USA. And they are online marketplace for many products such as weight loss products. What do you have? Face care, hair loss products, and many different health-related products. Even though the company is not a small cap anymore, by no means, it's a big company. I feel like when your total addressable market is basically health of the people in the United States, you are looking at pretty astronomical total addressable market. And if Hims and Hers can be the winner in that telehealth industry, they are in for a good ride for sure. So that's about the group of companies that I feel offer the best risk-reward profile at the moment. The companies, which I guess you already know before, I haven't even done my stock portfolio update video for this spring. I can tell you that after this 100 episode we are talking here right now, the portfolio update will follow, so you will actually see how much do I own these companies and which of them are in my portfolio. So if you are interested in that, please subscribe to the channel and wait for a little while, and I will get to that video really soon. But now we continue risk reward matrix quickly, talking about other companies here. Ulta Beauty just released good earnings, and the stock price unfortunately went up. So when the price goes up, the reward goes down usually, and in this case it it happens. So could be a good value today, but not as good as the ones mentioned before. Same thing goes with Greg's. Greg's stock price has been declining a lot recently, and this is one company that I'm really closely monitoring. Should I go in? But I haven't had yet that conviction to go in like the ones mentioned before here, I guess. Then I want to really address these two. Alphabet, I think, is now that the stock price has declined again, I know that the risk is here. Risk is not huge, but the risk has gone up due to, of course, fierce competition we know happening in AI in the search business, which is still Alphabet's biggest business, search. So that future of that search at Google remains unclear, at least to me, in this hyper-competitive AI landscape. So there goes the risk with Alphabet. Nevertheless, the company owns YouTube, to say the least. You are watching this video on YouTube, and YouTube is pretty much here to stay business. I would say they have Waymo, so self-driving cars, and they have a huge number of other businesses too that can be very good in the future. It's Google we are talking about. So to me, the valuation seems really attractive at the moment. Berkshire Hathaway is not a huge buy by no means. It's expensive stock, but you have still the legend Warren Buffett. Unfortunately, Charlie Munger is no longer with us, but you still have the legend Warren Buffett there making decisions, and Berkshire Hathaway cash pile is huge at the moment. So if you trust what Warren Buffett can still do with this, and I do trust him, I think why Berkshire Hathaway is looking pretty good is the big cash position and all the options that gives them probably in the near future. So what do we have then on the left side of the reward axis, so to speak? So companies I don't really see having a good valuation at the moment, or not the kind of valuation I would invest in. Let's go with the lower left corner maybe. First, Microsoft. Not terribly overvalued in my opinion, huge moat company. Canadian Pacific Kansas City, so railway. Maybe it's the turmoil that is going on in United States politics, but I a little bit lowered my valuation. The results were not, or then it's something going on with the economy as a whole, but I needed to a little bit lower my valuation on it. So not looking to invest now. I need to see the stock price going lower. Although I consider the company really interesting with the nearshoring trends and all of that, so I'm paying close attention to it. Apple and Meta, not like now that the stock prices have declined, they are not super expensive anymore in my opinion. When the stock prices come down, the reward usually goes better, and that's the case for big tech here, I would say. Amsterdam Commodities is just saw increase in their stock price, good results, I guess, good news from the company. So the stock price went up, and when the stock price went up, I don't think it's that great of a value anymore. It was, what is it trading now, 21.5 euros. When it was trading at 16 euros, it was value play, and I did buy it there. But now I decided to sell my small position. Hopefully it would crash to 15 euros and under, and I would definitely go back to Amsterdam Commodities, this trading business of spices, tea, and what you have there from Europe. And hoping for the stock price to decline a little bit, so I would re-enter to the company for sure. Then we have there, as I said, Lockheed Martin and General Dynamics. I a little bit increased their risk profile due to what the great management of United States is at the moment doing, and I don't think, as I said already, I don't think the executives of these two companies are happy at what they are seeing currently happening. Service still up in terms of valuation. Well, I have looked at, obviously. Unfortunately, when some industry is hot, it is hot, and there is not much value to be found, and it comes to nobody as a surprise that defense sector is really hot at the moment. So really, I'm not looking into it too actively, because I know there is no value to be found probably at the moment. Service Corporation, funeral home operator, biggest one in the United States, still overvalued. Nothing more to say about it. Disney, hugely overvalued, I think. Kind of problematic investment, I guess, for many people who have been 10 years invested in Disney, and the stock price has gone nowhere, basically. Of course, you have the dividend there, but yeah, streaming wars and stuff, I don't see anything with Disney, and would expect Disney to crash quite a lot if things get bad in the United States. Carriage services, I think I already mentioned, debt is, I'm not comfortable with the amount of debt they have at the moment. And also the valuation is high, so not for me. Then you have Alibaba there. Alibaba, of course, one of the success stories since last November. The stock price went up pretty hugely. And this is portfolio video coming up next, but I'm gonna make a big revelation here now to you and admit that Alibaba is out of my portfolio. So there goes China out of my portfolio. Many years I was invested in Alibaba, I think. Ended up pretty close of zero returns when I now sold Alibaba, and I think that was somewhat zero returns for me. Obviously, opportunity cost, that those years were lost in this investment. Of course, I don't like China and many things they are doing. There are risks, there are problems, and if I'm not seeing better developments on these aspects, also seeing Alibaba just going up with stock price, I don't want to be an owner of Alibaba now. let's see what the future brings. I'm not saying I will never ever invest again in China. I'm not saying that, but I think the risks. I'm finding good opportunities also elsewhere than in China. So maybe I'm getting a little bit more mature with this issue myself. So if I have great companies, which we already talked about in this video, why would I invest in China with how the world is at the moment? Basically, that's what I'm thinking now myself. Only my thinking, you might disagree, but yeah, this is my portfolio and I will make the decisions here on my investing. And then finally Tesla, we already talked about Tesla. If you're looking for a high risk, low reward investment, go with Tesla then, I guess. And risks are many. Valuation is, do you believe what Elon Musk is saying and what he will deliver in the future? What will happen in the future? Well, no concrete proof of anything in my opinion. And looking at what the man is doing, he shouldn't be the CEO of Tesla at the moment. I know it's his company, but I want to see somebody commenting down on my video, why is Elon Musk asset today for Tesla and not a liability after all of this? Go ahead, make your case. I'm willing to listen. So, this is my risk-reward matrix. Just some concluding thoughts here. If I'd be looking for lower risk and okay returns in the market at the moment, I'd turn my attention to Berkshire Hathaway, Google, and Greggs at the moment. Greggs, obviously UK's biggest fast food chain. For those of you who don't know what Greggs is, I would look at Greggs, Alphabet, and Berkshire Hathaway if you want to park your money somewhere in big companies that will exist for sure in 10, 20 years from now. If you're looking for that kind of investments, these are the best lower risk, okay reward offerings in my opinion in the market at the moment. But if you have a long investing horizon and appetite for risk, I'd explore Kamux, Dr. Martens, Uranium, and Origin Enterprises. Origin seems to offer also lower risk than these others, lower risk profile, so especially that is interesting, I would say, and highlight from this risk reward matrix. So if you are, for example, a young person under 40s, like myself I am, I would go look at this uranium as a commodity, and all the ways I myself have physical, mostly I have ETF and then physical uranium, which I own through a trust. So physical uranium, I would look at that. Kamux, Dr. Martens, Origin, those are, I'm saying if you are a young investor, because as a young investor you have many years to wait for this investment thesis to play out. If you are a little bit more elderly people and person and your aim is to secure that you don't lose much and you have your money somewhere that you can expect that the losses are not completely terrible if something unexpected happens, then I would look at Greggs, Alphabet, and Berkshire Hathaway from these big companies. And this was my 100th video at Arctic Money. Thank you for everybody who has been with me. If you have been since the start, or let's say since I made my 50th video, I would like to see some comments there and what you have maybe learned through 100 episodes of Arctic Money. If somebody has really been on this journey with me for this long. Myself, even though not many people watch my videos, I do these videos for myself as a tool to make sure that I understand investment so good that I'm not afraid to talk about it publicly on internet. Not going to embarrass myself if I talk about it. And this is kind of my own history log of my investing. So sometimes I look at my own videos and go back to them and see what did I tell you guys about this investment and a little bit refresh my thoughts on that. So I'm doing this for you, but I'm also doing this for me. And I'm happy and proud of these 100 episodes I have on Arctic Money. Big thank you to everybody who has been with me. Really appreciate every nice comment, every nice like I get to my videos. I really appreciate it and want to take this time to thank you. And now we see in the 101st episode, which will be my portfolio update video. So subscribe to the channel, like this video, show some support, and I will see you in that exciting video then. Thank you so much and bye bye.